we've got another lively looking week up ahead, even if the number of FTSE 100 firms with scheduled statements or events is down to just 6. Now that may help to put macroeconomic issues centre stage, and the big issues to watch here are as follows. So on Wednesday the 30th of November, the latest OPEC meeting starts in Vienna. Everyone will be looking to see if the oil producers group can agree on the output cuts which were first discussed in Algeria back in September. On Thursday the 1st of December, we have the latest Purchasing Managers Indices or manufacturing sentiment surveys from the UK, US, Europe and China. Any score above 50, well that's generally seen as pointing to future growth. Any score below is a potential warning that a slowdown or recession may lie ahead. And then on Friday the 2nd of December, the third macro point, we get the latest US monthly non-farm payrolls data. A strong figure here. Anything around October's 161,000 additions could set the seal on a US Federal Reserve rate rise on the 14th of December. Now at the company level, items to note could include a trading statement from FTSE 100 theme park operator Merlin on Tuesday the 29th, full year results from Sage, and maiden interims from waste disposal firm Biffa after its recent return to the stock market on Wednesday the 30th, and finally marketing giant WPP's analyst meeting on Thursday the 1st as well. But for the update which could really create the most fuss in the week ahead, I think we need to look at house builder Berkeley Group, who's due to put out numbers on Friday the 2nd of December. The company builds high-end dwellings under its own name, as well as brands such as St Edward, St George, St James and St William. And I think there's a theme there. At around £25, the shares are way down from their highs of nearly 38, as we can see here. Now that slump can be blamed on fears that there are signs of a cooling in the high-end property market in London and the South East, where Berkeley is primarily active. This in turn is being blamed on the EU referendum result, concerns over what Brexit might mean, and also the increases to stamp duty land tax pushed through by George Osborne just before he lost his job as Chancellor of the Exchequer. Now in its September trading statement, Berkeley also flagged a policy pickle and what it called tension between government policy on starter homes and the new London Mayor Sadiq Khan's drive for more affordable housing. At that time, boss Rob Perrins and Chairman Tony Pidgley flagged a 20% year-on-year drop in new house reservations across the first 5 months of the year. So, the key numbers to watch with Berkeley's first half numbers will be as follows. First, the trend in reservations and whether there's been any stabilisation here. This will also be reflected in the order book, which came to £3.25 billion at the end of its last fiscal year. Second, look at the trend in pricing. Barratt Developments has already flagged its cutting prices in the London area, so let's see if Berkeley are having to do the same. In its last full year financial year, Berkeley's average selling price was £515,000, although that did represent a 10% drop on the year before. This graphic shows how Berkeley's ASP, annual average selling price, has developed since the end of the Great Financial Crisis. Third, we've got to look at earnings. For the full year, analysts are still looking for a 45% increase after a flat year last year, so I guess that's a good benchmark for the first half. Also remember, the company has a target of delivering $2 billion in pre-tax profits in the 3 years to April 2018. And finally, we've got to look at net asset value per share. Now that came to £13.14 at the full year stage. This last chart shows how the NAV has developed on an annual basis also since the Great Financial Crisis. Now Berkeley shares still trade at a big premium to that NAV despite the questions over current trading. That's partly down to the visibility given by the fat backlog, but also the company's plans to return cash to shareholders. It intends to pay £10 a share in dividends spread evenly over the next 5 years. On that £25 share price, that's an annual dividend yield of some 8%, about as high as there is right now in the FTSE 100. The market is clearly saying it doubts whether the cash will be returned in the event of a sharp housing downturn, even if Berkeley has a healthy balance sheet. So let's see how these interims shape that debate. Thank you for watching, and I look forward to seeing you next time.